In today's episode, I'll talk about two interesting stories. In the first story of the day, I'll talk about Donald Trump's tariffs once again, but this time I'll actually analyze its impact on India. And in the second story of the day, I'll analyze the paint sector of India with some insights from the quarterly results of the biggest paint companies of the country. Welcome to the Daily View Show by Zerodha, where our aim is to simplify the biggest news and stories in the financial markets in a way that is easy for you to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Friday, the 14th of February. Let's begin with the first story. Look, recently the United States has become very fixated on using tariffs as a way to even out what it considers unfair treatment. Now, very quickly, a tariff, for those of you who do not know it, is like a tax that a country puts on goods that are coming in from abroad, and these can basically make these particular goods more expensive and therefore give local manufacturers a chance to do better in the home market. Now, Donald Trump has been one of the leading voices in this approach, and his main message is that if any country charges higher import duties on American products, the United States will raise its own tariffs on that country's goods in order to match it. And this move is described as a reciprocal tariff. Now, India is right in the middle of this because in Trump's view, India has some of the highest tariffs around the world, which is why he also once called us the tariff king. Now, in order to understand why this is such a big deal for India, let's first quickly take a look at how the trade between our two countries has changed over the last few years. Look, under President Joe Biden, India's exports to the United States grew sharply to the point that the US is now India's largest export destination. In the financial year 2023, India sent goods worth about 78.5 billion US dollars to America, which worked out to be around 15% of all Indian exports. And in return, India bought far less from the US, leaving India with a surplus of roughly 45 billion US dollars. And this surplus is exactly where reciprocal tariffs could actually hurt India because Trump's plan is to put extra taxes on countries where he believes the trade balance is tilted too far against America. One more reason India is vulnerable here is the long history that we have had with tariffs. Going back to 1991, about 1/3 of the Indian government's revenues have come from import duties. Now, even though India has lower tariffs in many areas, we still put higher import taxes on certain products than what the US does. In fact, among large economies, India's average tariffs remain on the higher side, to be honest. And this means that we stand out as a prime candidate for Trump's reciprocal tariff plan because he believes that the US should match or even exceed any high tariffs that India or any other country imposes. And if the US goes ahead with all of these tough measures, we in India will find it very difficult to retaliate in a similar way because we only account for about 2% of total American exports. And that gives the US a much stronger position in order to pressure India into any sort of trade battle. But that said, there is still a small pressure point that India can use, which is our annual import of around $10 billion of American oil and gas. So in theory, India can definitely threaten to cut those orders, but in actual reality, they only make up about 0.5% of American exports. So it may not even worry the US too much here. Also, it's important to note that even though India could suffer from these tariffs, we may not be as badly hit as other countries which depend heavily on exports to power their economies. India's exports hover around 20% of our GDP, while a country like Vietnam exports goods worth almost 90% of their GDP. Vietnam, therefore, is far more exposed if any major trade war breaks out, and that is because a bigger chunk of their economic activity is tied up in what it sells overseas. India's smaller reliance on exports could give us a layer of insulation here, although losing a major market like the United States would still hurt us pretty badly. Now, the Indian government, meanwhile, is taking steps to smooth things over before it becomes a crisis. One example is that the Indian government has been trimming tariffs on certain items, including those that Trump has complained about during his earlier presidency, like heavy American motorcycles, etc. India, by the way, is also showing willingness to buy more products from America. For instance, Indian energy companies are thinking about importing additional liquefied natural gas or LNG from the United States. On the immigration side, India has gone along with some American demands, like cooperating when the US decided to deport certain Indian nationals, perhaps to signal goodwill. But beyond just trying to make peace with America, India is also trying to hedge its bets by pursuing various free trade agreements with other countries in order to build alternative channels for exports in case the US imposes punishing tariffs on us. But even with these preparations, roughly $80 billion worth of Indian exports could be on the line if tariffs start to escalate. And there are multiple different ways this could play out. One optimistic view is that India might actually strike a more favorable deal with Trump or any future US administration, winning exemptions that give Indian companies a leg up over other emerging markets like Vietnam or Indonesia. If the United States wages a broader tariff war, especially against China, India could end up benefiting if global supply chains decide to shift here. A more likely scenario here is that India sees moderate tariffs similar to what other emerging markets are facing, which might slow down some export growth but not really cause a full-blown crisis. Then there is also a pessimistic view where Donald Trump brings back the strong rhetoric about India being the tariff king, and this could lead to a serious trade war that would upset Indian export plans. And that could mean Indian businesses which depend on the US market scramble to find new buyers or pay more to keep selling in America. Also, things become a little more complicated once you start to consider the unpredictable second order effects of all of this. For example, in the earlier US-China trade war, China's response was to devalue its currency, which made Chinese goods cheaper in other countries also. Indian manufacturers were then under pressure from cheaper Chinese imports. And if the US now targets India, we could very well see other countries jump in with their own strategies, so it is very hard to say exactly who will end up winning or losing in every situation. For India though, the real crunch might be in those sectors that count on American buyers. Precious stones, jewelry and cut diamonds often appear at the top of India's export list. Pharmaceutical items are also another big part of the story because a large share of India's generic medicines and other pharma products are sold in the US. Then there's also refined petroleum, engineering goods like industrial machinery and also automotive parts and textiles, especially garments and home linens. And altogether, these industries form a large chunk of India's shipments to the US. Also, tariffs directly affect goods, but services can also face a lot of trouble if this relationship starts to become sour. Indian IT companies, for instance, earn most of their revenue from American clients, and while the US cannot really put a direct tariff on services the same way that it can do on goods, it can use other tactics like tightening visa rules or bringing in regulations which make it harder for Indian tech firms to operate. There is definitely no certain way to predict where all of this will eventually land. The best case scenario here could be India securing some sort of understanding with the US, so we come out with fewer losses than other emerging markets. And the worst case scenario here would have American tariffs soaring, India retaliating unsuccessfully, and key Indian exporters suffering heavy damage. Now, somewhere in the middle, it's possible that we see moderate tension with India turning to other trade partners in order to make up for any losses in the American market. And of course, all of these outcomes will heavily depend on ongoing negotiations, political calculations, and a host of global factors that might really change very, very quickly. For now, there is a lot at stake for both Indian exporters and American businesses, and it all sort of hinges on how these tariff disputes move forward. With that, let's move on to the second story of the day and talk about India's paint sector. Look, the quarterly results of India's largest paint companies have recently come out. And just like every other sector, my idea here is to take a look at what is exactly happening with some of the top players in this sector in order to get a sense of insights and trends in this sector. Now, this sector is important because it is also connected to real estate and construction, and therefore, paint sales can also tell us a lot about home building activity in our country. And it's not just that, the paint industry also relies on raw materials tied to crude oil, so its costs are heavily influenced by global price fluctuations. And on top of that, painting or even repainting a house is a choice that people make when they have extra cash, and that means paint sales can reveal how confident or even cautious consumers feel in general. So all of this makes the paint sector a helpful way for us to understand broader economic signals. And in the latest results, most paint companies have shown signs that the economy's current conditions are a little bit challenging. Volume growth in many places was weak, and even though raw material prices dropped a little bit, companies could not really raise their own prices too much. Then there is also new competition. Grasim Industries, for example, has entered the market under Birla Opus brand, which is aggressively expanding and also keeping prices in check. And this has led many of the established players to spend more on marketing and promotions, which has eventually led to a squeeze on margins. Asian Paints, which is a big player in the market, had a fourth straight quarter of declining revenues, and they posted a year-on-year drop of about 6%. Their volumes grew only by about 1.6%, and their overall value growth actually fell this time around. And that means that while a few more units might be getting sold, customers are actually choosing cheaper products now, so the total revenue per unit of paint is actually ending up going down. And that is putting a lot of pressure on margins because at the same time, the company is offering discounts and spending heavily to protect its market share. Another thing that's worth noting here is that Asian Paints' attempt to expand into the broader home decor business did not quite go as planned this quarter. Their lighting and window segment saw a notable revenue decline. Moving on, Berger Paints had a slightly better performance than its peers and they now hold over 20% of the market share. Even though their volume growth stood at around 7.4%, which is fairly decent, their value growth was only 0.4%. Now, in large part, this was all because they had reduced their prices earlier on and they also saw an increase in the sale of lower value products like texture paints and tile adhesives. Also, Birla Opus has not hurt Berger as much as people expected, possibly because Berger has always been strong in premium and exterior paints. They are predicting double-digit volume growth in the upcoming quarters, hoping that rising government spending on infrastructure and a pickup in urban demand will help them out. Moving on, let's also talk about Grasim or Birla Opus. Now, their quarterly paint sales jumped from around 400 to 450 crore rupees to 650 to 700 crore rupees, which is quite a big of a leap. Now, the company has reached more than 5,500 towns and has introduced over 1,000 different kinds of paint products. They want to sign up 50,000 dealers by the end of this financial year, so they're burning through a lot of cash in the process of doing so. And therefore, at the moment, Birla Opus is posting losses and its net debt has gone up. But Grasim is expecting that once their market share grows large enough, the business will fund its own growth. And that is why they are continuing to invest heavily in new plants with an aim to become India's second largest decorative paint company in terms of capacity by as early as 2026. Moving on, one big reason why paint companies very closely watch crude oil prices is because a large portion of their raw materials come from crude-based chemicals. Now this quarter, raw material costs softened slightly, but the rupee's depreciation offset most of that benefit. And because of the new competition, companies have now found it very hard to pass on any cost increases to customers, and that has kept prices from rising much. Asian Paints was the only company here that managed a small price hike of about 1.6%, which honestly is a very low figure as compared to how much more they were able to increase prices in the past. One more important observation is that paint demand has been fairly flat or even slightly negative in some places. There is a very clear sign of down trading, which means customers who used to buy top quality paints are now sort of settling for cheaper options. And that reality is very easy to spot in Berger's results, where decent volume growth exists, but higher end product sales have sort of slowed down. And when higher price goods are not really selling, overall revenue growth remains to be low and margins get squeezed. But that said, while individual customers seem to be cautious, large projects and infrastructure related orders are holding up a little bit better. A good chunk of paint demand, which is around 3/4, comes from repairing homes. But the remaining bit depends on new construction. Now, these particular results suggest that there is a healthy level of ongoing institutional work, including commercial buildings and government projects. Yet, the retail side of the decorative paint market looks weaker, especially in the affordable housing segment. Now, one puzzle here is that premium housing markets have reported strong home sales, but this has not really translated into a big jump in premium paint sales. This could be a case that buyers are now waiting before they do up their new homes. Also, another split in the market is between decorative paints for homes and industrial paints for things like cars, machinery, and industrial equipment. Companies like Akzo Nobel and Kansai Nerolac, which have more exposure to industrial paints, saw fairly steady demand from automotive, mining, and infrastructure projects. And this matches the trend of robust government-led capital spending in infrastructure. But that said, they still face pressure from weaker export markets and some selective slowdowns in commercial vehicle and tractor sales. So if I were to put it all together, these paint companies' results presents a picture of an economy where consumer spending on nice-to-have things is under pressure, while large construction projects and infrastructure investments are faring a little bit better. Crude oil prices could swing either way, making things a little bit uncertain. For now though, it looks like strong competition, tight pricing, and a shift in buying preferences are causing big changes in a traditionally stable industry. And that is why paints is an industry that is definitely worth keeping an eye on. With that, let's move on to the final section of the day, which is the quick news headlines. First, ONGC NTPC Green has signed a deal worth 19,500 crore rupees in order to acquire Ayana Renewable Power. This is ONGCPL's first big acquisition since it was set up in November 2024. Ayana, which was founded in 2018, owns 4.1 gigawatts of operational and under construction renewable energy projects. And this move supports ONGC's goal of reaching net zero by 2038 and NTPC's target by 2050. Second, India's retail inflation dipped to 4.31% in January 2025, down from 5.22% in December. This was mainly driven by food inflation dropping from 8.39% to 6.02%. Vegetable price inflation also eased to 11.35% year over year, down from 26.6% in the month of December. The RBI is expecting average inflation of 4.8% in FY 2025 and 4.2% next year, which raises hopes for further rate cuts after February's reduction. Third, Ahmedabad-based Torrent Group has purchased a 67% stake in the Gujarat Titans from CVC Capital Partners for 5,000 crore rupees, which values the IPL team at 7,453 crore rupees. CVC will keep a 33% share, but the deal still needs approval from the BCCI. That's all the news and stories I have for you today. I hope you enjoyed this episode and maybe learned something new from it today. This is your host Anurag Bansal signing off. I'll see you in the next episode. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.